Warren Buffett's Berkshire Hathaway owns 400 million shares of Coca-Cola that generate $700 million a year in dividends. And Coca-Cola is popular amongst financial pros too. It's their top non-alcoholic beverage stock search over the last month on Trackstar and has been for the better part of a year. And with the markets as bad as it is, investors have been parking their money in safe haven stocks like Coca-Cola. But sales are softening and Coca-Cola is facing inflationary pressures like every other manufacturer. So how safe is this blue chip? Coca-Cola is the world's largest distributor of non-alcoholic beverages and one of Warren Buffett and Charlie Munger's best investments. They love the company because of its branding, which allows it to charge a premium for its drinks. Coca-Cola has 140 products in its portfolio, including the brands Coca-Cola, Diet Coke, Fresca, Dasani, Minute Maid, Sprite, and Fanta. The company faced higher expenses over the last couple of years as aluminum prices and transportation costs skyrocketed. This led the company to increase its prices to offset these pressures and maintain margins. But Coca-Cola has struggled to grow revenues over the last several years. It made $41 billion in revenues in 2016, and in 2021 it did $38.6 billion. That could be because there's been a big push towards less sugary drinks and more competition entering the space. However, Coca-Cola's revenues have bounced back, and its current 12-month trailing revenues stand at $41.3 billion. Coca-Cola has $11.6 billion in total cash and $42.8 billion in total debt. And while that might sound scary, the firm has a current ratio of 1.1x and it pays a handsome dividend of $1.76 per share annually. Coca-Cola also has a PE GAAP ratio of 24.9x, which is more or less in line with its competitors. This could be because investors view Coca-Cola as a safe haven stock, so they're willing to pay a premium. Coca-Cola has a gross profit margin of 58.8%, notably higher than its competitors. In addition, none of its competitors can match Coca-Cola's net income margin of 23.1%. The firm's operating margin is 28.7%. Moreover, only Nestlé's $13.7 billion cash from operations beats Coca-Cola's $11.6 billion. Coca-Cola has put its foot on the pedal in the last couple of years, generating revenue growth of 13.4%. Only Monster, a significantly smaller company, beats that with 16.7%. Moreover, Coca-Cola's EBITDA growth is 1.5%, while Dr. Pepper and Monster have negative EBITDA growth. In our opinion, this is a 6 out of 10 ranking stock. Coca-Cola's dividend yield is especially attractive. The stock has held up relatively well in 2022 and should continue to do so over the next year or so. The problem is the company's size and lack of innovation hampering its growth. While we don't think it's the most exciting company in the world, it is the best stock in its category and probably a safe bet in an economic downturn.